Welcome to This Explainer. Today, we're stepping right into the shoes of an expert investment analyst. We're going to take U.S. Bancorp, one of the largest commercial banks in the U.S., and run it through an absolute gauntlet of valuation frameworks. We aren't just looking at standard metrics today, we're channeling the brilliant investment philosophies of legendary investors like Warren Buffett, Peter Lynch, and Benjamin Graham, before pressure testing everything with some strict quantitative models. Here is our roadmap for today. We'll start with a quick U.S. Bancorp snapshot, then look through the Warren Buffett lens, followed by the Lynch and Graham lenses. After that, we'll dive into a DCF valuation, check out a couple of alternative models, and wrap it all up with a final synthesis and recommendation. Let's get into it. Section 1. U.S. Bancorp Company Snapshot. Our anchor for this entire analysis is $62.13. That's the current trading price for U.S. Bancorp, ticker symbol USB. Every single intrinsic value we calculate today is going to be measured right against this baseline, just to see if Mr. Market is offering us a juicy discount or charging a premium. Now, U.S. Bancorp is incredibly diversified. Looking at their Q1 2026 data, they pulled in a massive $7.28 billion in total net revenue. And how does that break down? Well, 46% comes from wealth and corporate banking, 31% from consumer banking, and the remaining 23% from payment services. So you're not just buying a corner savings and loan here. You're buying a complex, multi-layered financial machine that serves 15 million clients. And they definitely sit at the big kids table. With $688 billion in average assets, they rank fourth among their peers. They're trailing right behind those massive money center banks like JP Morgan, Bank of America, and Wells Fargo. This sheer scale is absolutely crucial to keep in mind as we dive into our guru analysis. Moving on to Section 2, the Warren Buffett lens. As Buffett famously said, price is what you pay, value is what you get. Always demand a margin of safety. His philosophy is wonderfully simple in theory, but man is it strict in practice. He demands an identifiable economic moat, consistent earnings, manageable debt, honest management, and above all else, a rock-solid margin of safety between the intrinsic value and the current stock price. So how does USB stack up against the Oracle of Omaha's checklist? Qualitatively, really well. They've got a wide moat, thanks to that top 5 scale and high switching costs for those 15 million clients. The management team, led by CEO Gunjan Kedia, looks highly competent. They just braved through the rigorous Dodd-Frank stress test, proving they can weather a severe recession. They're also printing a very strong 17% return on tangible common equity, proving they're highly efficient. Plus, their earnings are super consistent. In fact, their Q1 earnings per share actually jumped 15% year over year. But here's where that strict Buffett discipline kicks in. He loves owner earnings, basically free cash flow. But for banks, traditional free cash flow gets completely distorted by loans and deposits moving around. So as a proxy, we use annualized net income. Specifically, looking at net income excluding intangibles amortization, we get roughly $7.8 billion annualized. If we apply a conservative multiple to that and demand a strict 20% margin of safety, well, Buffett's framework tells us he wouldn't even touch the stock until it drops below $49 a share. Great business, but for him, the price just isn't right. Section 3, Peter Lynch and Benjamin Graham. Let's shift gears to the legendary Peter Lynch. Lynch loved categorizing companies, and he would absolutely peg U.S. Bancorp as a stalwart. You know the type. Large, reliable companies that aren't explosive fast growers, but they give you great downside protection. He was huge on strong balance sheets, and USB delivers with a 10.8% common equity Tier 1 capital ratio. He also loved a growing dividend, and USB just bumped theirs up to 54 cents a quarter. But if you know Lynch, you know his absolute favorite metric is the PEG ratio, price to earnings divided by growth. Let's do the math together. If we take that Q1 EPS of $1.18, annualize it, we get an estimated $4.72 for the year. At our $62.13 stock price, that gives us a PE ratio of 13.1. Divide that by their stellar 15% year-over-year growth rate, and we land on a PEG ratio of 0.87. Since anything under 1.0 is considered undervalued in Lynch's playbook, this framework is flashing a very strong buy signal. Okay, but what about the father of value investing, Benjamin Graham? Graham requires a stock to survive a grueling defensive checklist. Let's see. Adequate size? At $688 billion in assets, pass. Earning stability? Pass. Fantastic dividend record? Pass. He wanted a PE under 15, and we know USB is at 13.1. pass. He also demanded a price to book under 1.5. If we take USB's $65.8 billion in equity and divide it by roughly 1.56 billion shares, we get a book value per share of $42.17. That makes our price to book 1.47. Amazingly, US Bancorp passes every single one of Graham's defensive tests. So the real test is his famous intrinsic value formula, the square root of 22.5 times earnings per share times book value per share. If we plug in our $4.72 EPS and $42.17 book value, the formula spits out an intrinsic value of $66.92. With the stock currently at $62.13, there is a discount, sure, but it's a super slim 7% margin of safety. Graham was notoriously stingy. For a deep value guy like him, he'd likely rate this a hold until that margin widens, probably waiting for it to drop below $47. Moving on to Section 4, Discounted Cash Flow Valuation. All right, let's get into the hardcore quant stuff. Valuing banks with a DCF means forecasting out proxy cash flows and discounting them back to today. We're assuming a standard banking cost of equity, or WACC, of 9%. We'll also assume a realistic 5% cash flow growth rate over the next 5 years, followed by a perpetual terminal growth rate of 2%, which basically just paces inflation. When we crunch those numbers, our base case DCF yields a fair value of exactly $68 per share. But as we all know, a DCF is only as good as its assumptions. This sensitivity matrix shows exactly what happens if our crystal ball is a little foggy. If interest rates rise and our discount rate spikes to 10%, our fair value plummets to $62. On the flip side, with an 8% discount rate and slightly stronger terminal growth, the value rockets up to $82. At our current $62 price point, the DCF base case of $68 suggests the stock is fairly valued, but definitely not screamingly cheap. Section 5, Alternative Valuation Models. To be as thorough as possible, let's run 2 alternative models. First up, the dividend discount model, which is actually highly effective for banks since dividends are cold, hard cash returned directly to shareholders. Assuming 5% dividend growth and a 9% cost of equity, the DDM gives us a fair value of $54. Second, we look at comparable multiples. If we apply a peer average PE multiple of 12 to our projected $4.72 EPS, we get a fair value of $56.64. Both of these alternative models drag our overall intrinsic value estimates significantly downward. Finally, Section 6, Synthesis and Final Recommendation. Here is our ultimate scorecard, and wow, the signals are incredibly mixed. Peter Lynch is the lone bull on the field, seeing that 15% growth rate as a clear trigger to buy. Benjamin Graham and our DCF model see the stock trading right around fair value, signaling a solid hold. Meanwhile, Buffett's strict margin of safety, along with our alternative DDM and comps models, suggest the stock is actually slightly overvalued at $62.13 and advise that we just wait. Now, fundamentally, US Bancorp is a phenomenal business. They're executing incredibly well. Their recent acquisition of the institutional trading firm BTIG really expands their capital markets reach. They just launched new prime business credit cards with Amazon and even struck a major partnership with the NFL. But there are absolutely risks to weigh. They are highly sensitive to macro interest rates, and regulators require them to hold a strict 2.6% stress capital buffer. That legally limits just how aggressive they can be with share buybacks and dividends. So blending all of these frameworks together, our final recommendation as an expert analyst is a confident hold. US Bancorp is a fantastic, high-quality franchise with stellar management. But at $62.13, the margin of safety simply isn't wide enough for a true value investor. If you're disciplined, keep this one on your watch list. Wait for a broader market dip to pull the price below $55 before initiating a position. I'm going to leave you with this final thought to ponder as you review your own portfolio strategy. Does US Bancorp's stellar 15% EPS growth justify paying a premium today? Or will patience reward you with a guru-approved margin of safety? Are you willing to pay up slightly for quality and growth like Peter Lynch? Or are you going to demand the absolute safety that Buffett and Graham require? Thanks for joining this explainer, and we'll see you next time.